financial statements, the reason that they're important and the reason that we all need to learn to use them is because at the end of the day, as I always say, nobody starts their business because they were actually just trying to start their business because it was the most fun thing they could think of. Of course, that is one of the major reasons, but that's not the only reason. You also want to make money. You want to make a good living. You want to support your children. You want to support your parents. We all got dreams of paying off our parents' house or buying our parents a house or taking them on a vacation, doing whatever it is that we think we might want to do for our parents. And if you're running a business, your financial statements hold a lot of secrets that help you get to the next level of doing that. I wish there was a way you guys could like see me while I was there. Probably is, but like I said, I'm not that. This is my first time going live. I'm a little nervous because anyway. Um, yeah. So as far as financial statements go, right? The way that you should think about your business is kind of like a casino, right? Um, when you go into a casino, you have a set of choices. There's a bunch of different games that you can play, right? So one game might be slots, another game blackjack, one game is craps, um, whatever they craps. We'll call it craps, and then there's like roulette. So when you think about those different games, there's varying levels of risk associated with each game, and depending on the type of person you are, that tells you which type of game you're going to play. So, for example, if you're somebody that's very risk averse, you might stick with blackjack or slots. Why? Because blackjack, you feel like you have more control. Slots, you feel like you're risking less with each go round that you take. Um, in terms of securities or in businesses, you're the type of person who might invest in Coca Cola. Why? Because it's solid growth and you're going to get dividend payouts. I'm going to explain what all of this stuff means, hopefully within an hour. Um, but I'm just kind of giving you a background right now. So another thing is that as a consultant, and what I've heard from accountants is when I go into a business to work with them, one of the first things I ask them for is their financial statements. The reason why I ask for that is because that tells me everything that I can find out about your business. You're going to tell me a bunch of things that you think you know, right? But by virtue of you calling me a consultant, you know there's a bunch of things that you don't know, right? My job is to figure out those things that you don't know and present them to you. And one of the best places to find that information, find those secrets, is within financial statements. Accountants, one accountant I know charges, he told me once, $100 a month for every month that he has to go back and basically figure out what your financial statements should look like when he's doing taxes for somebody. So another good reason to have your financial statements in order, know what they mean, know how they work, is because it saves you money on taxes. Your accountant doesn't have to charge you as much because they don't have to go back and put together a whole bunch of stuff from 12 months ago in order to, turn in your tax documents. Okay, so what you see before you is the 2018 annual report, the balance sheet for Lumber Liquidators. Okay, if you never heard of Lumber Liquidators, they are a retailer, major retailer here in North America. And they have, I don't know how many stores they have, I didn't see that in the report, but they have, they're considered a small cap company. Now, I don't know what their valuation is. I didn't really look that up. I was just trying to get you guys some relatively simple financial statements to look at. But small cap just means that they don't have a large valuation or they're not considered a very large company within one of the indexes on the market. Okay? So this company is simple enough to look at and we'll go through and dissect some things. So first let's break down what the anatomy of a financial statement is, right? So this is not the balance sheet. This is the income statement. Um, and what you see here is the sales here at the top. Okay. And then we get to, I kind of downloaded a little thing down. I'm not even using. Right here, we get to cost of sales, okay, which is cost of sales is how much it's a variable expense. Okay, variable expenses are expenses that change as you sell more, right? The simplified way to say it is they change the more you sell. So you can think of variable expenses as things like if you have hourly employees that work directly in sales, like so your sales team, something like that, they may be a variable expense because their commissions go up and down the more they sell. Okay. However, the manager of your store, the manager of your location would not be a variable expense because their salary is probably the same no matter what, right? That's just an example. It can change and it gets more convoluted, but that's a simple way to say it, right? Each one of these lines is considered a line item, okay? And each line item corresponds to whatever that amount is that you see there, okay? Down here, you have your selling and general administrative expenses. These are your expenses within the company, your fixed expenses, so to speak, because it doesn't necessarily mean it is a fixed expense. If it's within that level of expenses, it just is an expense. Okay. So these expenses, fixed expenses, don't change. So that would be like your manager's salary. Um, and you'll see here that these expenses tend to be things that kind of stay in place. I always look at it like that, but again, it's not necessarily like that. And when you ask your accountant, oh, disclaimer, I am a consultant, okay? Just so you guys know. So I look at financial statements in one way, which of course I'm biased, I think is the best way. Accountants look at it different ways, and a finance professional might look at it in a different way. I'm a consultant. I look at this and try to give you the reality of whatever it is to figure out whatever it is you want to do, right? Finance people are going to look at it from a financial perspective. So they're looking at about how do we generate the best return for what we have in front of us. And accountants tend to look at history and try to make assessments of a business based on the history of the business. And that's a very simplified way to look at it also. But that's just where we're going to leave it so we don't get no arguments. All right. So the income statement basically is the representation of the operations of your business. Okay. So this is how well your business performs day in and day out, year over year, month over month, so on and so forth. Right. We also have the balance sheet, which shows us a financial snapshot of the business at that particular time. So you'll see here it says December 31st, 2018. If you can see it. Okay, won't zoom in for me. Um, but December 31st, 2018, this is what the finances of the business look like. Okay, you can see each line, right? So the income statement gives us operational information, right? So for example, if a client came to me and said, "Hey, I'm not generating enough sales," that's a two-pronged question. You could either not be making enough, you're actually not selling enough units, or you're not pricing your product right. Those two problems are two very different issues because if you're not pricing your product correctly, right, and that could lead to other issues as well. It could be margin leakage, which means you basically give away too many discounts, um, or a whole host of other issues that come in to play with pricing. Then you also have, if you're not making enough income because of lack of units sold, well, then we need to do a completely different analysis. And that's why things like these financial statements come into play because they can tell us this kind of information offhand. So if you look at this, your gross profit is a line item that basically represents how well does the product or service perform on its own, right? Separated from the rest of the expenses of the business, the gross profit line tells us how does the business perform, the, the essence of the business in and of itself. You know, without because your fixed expenses, your expenses below the gross profit line can they're up to management, right? So management could be paying too much in rent. That's what's causing the problem. Management could be the salaries can be inflated. You guys could be spending too much on vehicles, and that's due to lack of maintenance staff or whole host of other issues that actually have nothing to do with the product itself. It just has to do with management's choices. Whereas up in this section of your income statement, this tells you a lot more about whether or not the product or service in and of itself, or the products or services of the business in and of themselves, perform well within the market itself, right? So we can use this information in this part of the income statement to explain more about what's going on in the marketplace. as opposed to the rest of the information, because that's more so management choices. Okay? So this is not meant to be an accounting lesson, but to understand your balance sheet, you need a little quick bit of accounting, right? So balance sheets have assets, liabilities, and equities, right? For any balance sheet, the assets have to equal the liabilities and the equity, or the company is out of balance, which means something within the finances is out of order. Whenever I teach accounting, one of the best analogies I've ever thought of is that assets, what liabilities and equity is money that is coming to the business from someone else or from the owners of the business, and they have to be used to buy assets. So if you have, so there's no way that you can account for the money that has come into the business to pay for the assets, and then have somehow more liability and equity than you would have assets, or you have more assets than you have liabilities and equities, because then something's not being accounted for. Okay, so the balance sheet is essentially, like I said, it's a financial snapshot. So if you look at the line items here, yeah, there we go. All right. So if you look at the line items that are here, right, you see there's things like cash and cash equivalents. You have your inventory. These are prepaid expenses, are expenses that we've already paid for. So it's an asset. It's something that we can say that we're collect future cash flow on. So now, down here you see that's property, plant, and equipment, or as other people like to say, capex, right, capital expenditures. Goodwill is usually from purchases of other businesses. Those are things that are left over that we can't really account for, but we know they have value. So if we buy a company for $1 million and they have $800,000 worth of assets, usually we'll say they have $200,000 in goodwill, which means that essentially that's the brand value in and of itself. So Macy's brand value, if Macy's was acquired, would be in the billions of dollars, and then we'll actually look at the hard assets on the books and say, okay, the difference between that is probably goodwill, give or take some amount. Okay, liabilities are accounts payable. So usually what you'll find in accounts payable are the bills, utility bills that we know we have to pay in the future that haven't been already accounted for in the income statement as an expense. You see they have customer deposits and store credits. So that's money they owe customers. Um, they got sued. You see they got sued with the legal matter, income tax and set and liabilities. Okay. And down here is stockholders' equity. The most important part of retained earnings, these come directly from the income statement, because this is the amount of money that you retained after you took profit and what you are looking at reinvesting into the business or distributing to shareholders, okay, the owners of the business. Okay, so that's a quick rundown, quick and dirty. So now let's get to what I think is the fun part, but I'm a bit of a nerd, so y'all might, hopefully y'all agree. So here's the type of information that is hidden within your income statement, right? So within your income statement, you see you have this information, but CAGR, or is the compound annual growth rate, is the amount that, the best way to explain it is that it's a comparison to a compounded, interest bearing compounded security of some sort, or you can use this number to compare it to another investment, right? But it's also a very good measurement of annualized growth over time. So, from what that means, if it's too nerdy, um, basically we're saying that the revenue from merchandise sales grew 2%, right? But the service revenue grew 26% over the same period. So, what that tells us, right, is that even though the lion's share of revenue, which you see is these numbers here, which I'll get to in a second, we still have a lot of growth in our compound annual growth rate within that service revenue, right? So when you look at the numbers, these are in thousands of dollars. So that's actually $64 million, it's $90 million, so on and so forth. It looks like, oh, well, we should focus on our merchandise sales. And for sure, right now you should. But what the trend is showing us is that, over time, our service sales are growing a lot faster. So really what we should be putting money into is how do we continue to grow our service sales at that level. Um, and I'm just giving you a quick rundown of what all this stuff kind of is, so it's not foreign to you. Okay, down here, these are growth rates from the last 2 years. So, right, so you see that the service revenue year over year, it actually grew only at 1.8%. Whereas the service revenue is growing year over year 41%, right? Uh, so you can look at these numbers in that link I gave you. If the link doesn't work, let me know because I don't know what's going on. Yeah, memories of financial accounting. Yeah, that's what it is. Um, so how do I get these numbers over here on this side? Basically, I take this sales line right here and I divide all these numbers by this sales line, which gives me the percent of sales that it is, right? How much of our sales came from this proportion, from this statistic, right? The reason that's important is because you'll see proportionally the lion's share of sales come from merchandise, and then we know exactly how much sales come from services. As far as the expenses go, we know how much of our expenses go towards from our sales. We know what percentage of our expenses that sale eats up. So if you look here at, I don't know why there's green. That's interesting. But they actually had losses for the last 3 years. Okay, so whenever I've analyzed companies in the past, one of the things that I did was whenever you do this, you can automatically see, okay, what happens with business owners a lot is that you get lost in all the different moving parts of everything that's going on and get used to doing the same things over and over that you always do, right? So you get your staff is used to it, everybody's used to it. So me as a consultant, I come in with none of that same anchoring, that mental anchoring that you all have, that a staff will have. And I can look at the business in a completely different way. Now, it's not that you couldn't do the same thing that I'm doing. It's just that you're in it. You have what's called the curse of knowledge. You know exactly what's already happening, how things work. I don't. So coming in and having to figure out everything, I can see different things differently than you can. And this gives me the opportunity to look and see those things quicker instead of having to learn it over time, right? So when I go through and I look at these financial statements, for example, that number 41.4%, that seems normal, right? With cost of merchandise sold is 63.4% of sales, right? So that might, in this scenario, because it's an asset heavy business, that's normal also. But in another business, I might look at it and say, okay, that seems a little high. Why is that so high? And then we will go through and say, okay, well, how do we reduce that number, right? What is causing that number to be so high? And then we would take our time and look through all the different angles and aspects and everything that's involved with producing that particular number and say, okay, here's our recommendation on why you need to, I don't know, automate your sales staff. That could be the issue. But nonetheless, that's one of the major reasons that we look at financial statements. The next thing, another thing is ratios, right? So balance sheet, you basically do the same thing, right? I just make everything a percent of assets, and then you just calculate it, and you look through the numbers, get the proportions, right? And down here, you calculate growth rates, right, year over year, and that could be another reason. So let's say a company comes and says, "Hey, I have last year we had a 50% profit margin. This year it's 10%. What happened?" Right? So you look through these numbers and you say, oh, okay, well, this particular expense increased from last year. Well, why does it increase? They say, well, I don't know. We've been doing the same thing we always do. And then it turned out maybe they had given away way more PTO. They're giving away way more PTO than they usually did, and that caused them to increase, expenses somehow. Things like that. So With all of that said, right, the most, yes, we do. That's exactly what consultants do. That's what we get paid the big bucks for, quote unquote. Hmm? You playing craps? I mean, whenever we had this admin meetup, we can get a game going, man. Anyway, uh, so ratio analysis. This is one of the most important things that you can do for your business. When you have this information in front of you, yeah, whatever. When you have this information in front of you, it tells you a lot about what's going on in your business, especially financially. Before we talk about that, let's talk about what's called the balanced scorecard approach to management. Okay, so the balanced scorecard is a strategic tool that you use in management where you organize your business into four key sections. Okay, the first section is the financial perspective. The second section is the customer perspective. The third section is the learning growth perspective, and the last one is the processes, technology, and tools. Right. Each section builds on the next. So let's say you have a financial goal of increasing sales by 50%. Okay, so you'll put that in your financial section. Um, the next thing you would say, okay, what do we need to do to get our customers to buy at a level that will increase our sales by 50%? That goes into your customer perspective. Okay, the learning and growth perspective is about your employees. And it says, what do we need to do for our employees? How do we need to train them? How do we need to grow them? Who do we need to hire in order to get ourselves to the point where we can get our customers to purchase at a higher level to the point where it increases our sales 50%? And then the last section is the processes and the technology. And you say, what do we need to change within our organization? All the way here at the bottom to enable our staff to be able to entice our customers to be able to purchase at a level that increases our sales 50%. So each section builds on the next section and gives you, and the whole hope is that you will have achieve your financial goal, which is, as I said, the whole reason for most of us, not the whole reason, but a large portion of what we're in business for. We want to make money, right? And if we're not making money, we can't stay in business and we can't do what we love doing. So you have to kind of start putting that to the forefront and using these financial statements to help you get there. So ratio analysis helps you figure out so many of those steps in between, right? Because what I do in my consulting practice is really help retailers figure out customer experience because customer experience is where customers are really focused at right now. Um, Nobody wants to go to a store anymore unless that store presents some reason for you to show up. Now, that reason doesn't need to be some kind of, you don't have to have a concert, you don't have to have a fashion show, you don't have to do all these things, but you do have to delight your customers at such a level that they feel like it's worth it to go to the store as opposed to going online. Um, Quick little quip on that. Uh, think about when you go to Macy's, right? You go into Macy's, you want to go in the store and buy something, and when an associate walks up to you and says, "Hey, may I help you?" Most people say no. I know because I used to be a Macy's associate. So, and the reason why is because the Macy's associate being there in the store does not present more value to you than you going online and finding the product yourself, right? To you, they're just a person who brings stuff up. If you can't find what you need, then they start to become more valuable. Well, the game is changing, and customers want people in the store who can actually help them, right? And help them figure things out, help them find things that they can't find themselves online. And if you're not providing that as a retailer, if you're not providing that as even in e-commerce, e-commerce is making that switch as well. If you're not providing those things, then you're going to see your sales start to dwindle because people are going to find whatever they can find the best way they can find it without having to go to you. Um, and that's why you're seeing so much decline in retail stores because the retailers are starting to realize this, and if they're not keeping up, they're closing. That's all that's happening. Think about Old Navy just closed a bunch of stores. Think about when you went in the Old Navy store. You went there for cheap clothes mostly, cheap, nice clothes. And now you can find that at Fashion Nova on Instagram or a plethora of other Instagram boutiques. So what's the point of going to Old Navy? What's the point of going in the store? It doesn't make sense anymore. Um, but retailers are starting to pick that. Anyway, back to ratio analysis. So each of these ratios represents some sort of different aspect of your business, some sort of key piece of information that you need to see. So, for example, your asset test ratio is a ratio that tests whether or not you have enough cash to pay all the liabilities that you have due within 1 year. So that means, can you pay the bills? Can you pay your credit line? Can you pay, um, all the vendors that you owe? Do you have enough capital on hand right now, enough cash right now on hand to pay those bills? So this company is actually, and just another little tidbit, they're actually a recommendation to buy because they're considered undervalued. These ratios will show you why in a second. So as far as their asset test ratio, they have 11 cents, right? That's what that number represents. 11 cents for every dollar of liabilities that they have, of current liabilities they have. Asset test ratio isn't that bad. Um, it's used for companies that are really on the cusp of having, like, you have really low cash flow, and things are starting to unravel. That's when we start to really look at the asset test ratio, because that tells us how how much trouble you're really in, right? So, and none of these ratios, by the way, are like the magic bullet. All of them have to be used in conjunction with each other and interpreted so you can understand what's going on. So then you have stuff like the current ratio. The current ratio is a ratio that says, do we have enough current assets, right? Things that we can sell almost immediately as quickly as possible. So big companies will have things like cash, marketable securities, inventory, and accounts receivable, so on and so forth. All these things do we think we're going to get right away, right? We can go into the market, get rid of them, get cash, pay our bills. So when you look at their current ratio, they're actually in a very good financial position in terms of their current assets, right? So largely, you see what they have cash wrapped up in is their inventories, and that's normal for a retailer. They have a lot of inventory. Um, for anybody who's into Six Sigma, they probably need to start implementing what's called Kanban, and you guys are probably seeing it in like Trello or some of your project management apps, and it's just a bucket system that helps you manage the speed of your inventory and reduce costs. But if you look at their current ratio shows that they have more than a dollar available to pay off every bill. They actually have enough money to pay every bill and have money left over. So they're not actually in a bad position, even though the current ratio would suggest so. Okay? Um, Working capital. So the financial definition of working capital is your current assets subtracted from your current liabilities. This is the amount of money they would have left over after they pay all the bills, which is shown by the current ratio, right? So it all makes sense. So the company is not in a bad financial position. It's not a dumpster fire. It's actually a pretty good position. And in terms of their stock price, yesterday was $4.90, I think. So this is why you'll see a lot of the analysts saying, okay, this is a buy, right? They're undervalued. They actually should be, or maybe there's a lot of growth and room in the market for them to come up. Lumber liquidators, they do flooring. There's no major flooring company, right? So they're probably figuring, oh, okay, they have a lot of room to grow and be the number one flooring company in the world, or whatever it might be, right? Okay, so your asset turnover ratio is your sales divided by your total assets, and it tells you how quickly you can turn over assets. Okay, how efficiently you turn over assets, so to speak. For them, they have, for every dollar they make, no, for every dollar they have in assets, they actually make $2.50 in sales. So it'd be pretty good for them. It's not bad at all. Basically, 200% return on the assets, something like that. Um, Inventory. That's supposed to be inventory turnover, not turnover. Um, so inventory turnover is the same thing as asset turnover, except as far as your inventory. Um, right. So it focuses on inventory. So your inventory turnover rate is how quickly do we turn over inventory, or how efficiently do we turn over inventory. Day sales outstanding. Uh, so this number, asset turnover is in dollars, just so you know, and inventory turnover is in days, like how quickly, the number of days. Um, so, and you see it's 162 days, so that's roughly half a year, a little over half a year in 2018, um, which speaks to them having so much inventory on the books, meaning that a way for them to really improve their business would be for them to reduce those inventory levels, which is totally possible in this day and age. So day sales outstanding is similar. It's the same thing. How quickly do we collect payments from our customers? Days payable outstanding is how slowly do we pay our vendors. And what you want to do is pay your vendors as slowly as possible and collect payments from your customers as quickly as possible, because what that does is increases the spread on those two things and creates cash flow, right? So anybody who, just so you guys know, you come up to a client, you ever talk to a client and they say, hey, we're low on cash and this could be a large problem, especially in small businesses, because a lot of times small businesses don't know that and they have a really hard time collecting payments from customers. Um, and I guarantee you the way that big businesses get big is because they don't care about their customers' issues as much as small businesses do, and they just get their money. Okay, that's just a little tidbit for you. Um, Days payable outstanding is how quickly we collect payments from our customers. So you see, on average, they take about 42 days, or now 45 days. Well, in 2018 anyway, 45 days to collect payments from customers. Um, Days sales outstanding, they take 28 days to collect payments from customers, and they pay uh, their vendors 45 days. Um, I don't know if any of you have ever been in procurement. You'll see in larger businesses, they take more time to pay client. They'll tell a small business, they'll tell a vendor, we'll pay you in 60 days. These types of things are why, because they're like, okay, our vendors, the people that we're going to collect payments from, we only give them 30 days. And we're going to tell you 60 days, because in between that time, we're going to use that money and do something else and make even more money. So the importance of all of this information is to find out the cash conversion cycle. The cash conversion cycle is a number that tells you how long does it take for them to. Is that spell? I can't spell, so don't look at y'all. If y'all look at these, don't judge me. Okay, I do numbers, not words like that. Anyway, um, the cash conversion cycle tells us how long it takes a business to go from a sale to actually have collected payment. So it's simply just adding together these three uh, metrics. Right? You add those metrics together, you get that number, boom, you know how long your business takes to collect cash. And that tells you, that's also another issue that tells you problems with cash flow, right? And I promise y'all, this is coming to a really good point. Okay, so the debt to equity ratio, most people can figure that out. It's just debt divided by equity. Your retention rate is that retention number I told you about, the retained earnings divided by your sales. I mean, divided by your profit margin, divided by your profit. That's your retention rate. Or you can just say netting, whatever. Just that's the number. Um, and then the profit margin is, the percentage of sales that we actually, um, sorry, the percentage of sales that actually went to profit. ROE is considered the DuPont analysis. You can look that up if you want and figure that out. But the main point in all of this is that you can actually figure out how quickly your business can grow. You can come up with the sustainable growth rate, which is this ROE times your retention rate, right? And that will help you figure out how much more room do we have to grow in our business over the next year, 2 years, over the next year, really, depending on what the number is. So once you know that information, you can start making some assessments. You can multiply this times your revenue, say this is how much we can grow revenue, and we know our asset turnover ratio is this. So we can start to, I think you divide that revenue number by your asset turnover ratio, and that's how many assets you would need. And if you don't have that amount of assets on the books, that's how much assets you need to buy, right? And if you don't have capital to buy those assets, that's how much of a loan you need to take. And then you can start to build out your budgets and do some capital expenditures, capital budgeting in your books. Okay, so long story short, that's why uh, financial statements are important. Okay, there's only two people in here. Y'all got any questions? Man? Nope. No questions. Well, all right. Thank y'all for taking the time and talk to you later.